Right now, we're going to welcome our next live guest. We've got Steve Saxon, partner over at McKinsey & Company, who's actually on the ground in China right now. Steve, thank you for joining us today.
Thanks for the invitation. Great to be on.
It's great to have you. And as we mentioned, you're in China. You're coming to us from over the Pacific Ocean. And China now is experiencing kind of one of the worst COVID-19 outbreaks since the start of the pandemic. And thus with that comes brand new lockdowns, new mandates. Can you tell us a little bit about what's going on and how that's affecting shipping?
Yeah, absolutely. So I'm based in the key export city of Shenzhen in China. And countrywide in China, we're seeing a few thousand COVID cases per day. Put that in context, that's nothing compared to what many other countries are seeing. But China still has a zero COVID aspiration. And it's clear that China continues to target zero or dynamic zero. And therefore, the only way to get there is through extensive testing and in some cases, lockdowns. Shenzhen has just come out of a 2-week lockdown period where we've seen many of the key factories stopped, many communities closed down, and therefore the truckers have been unable to move the cargoes out of the factories. The ports have continued to be open, and so we have seen the throughput moving. But if there's no truck availability and the factories are not producing, we've obviously therefore seen cargo slow down over the last week.
And Steve, one of the big things that's really impacting the supply chain for those that have really been watching is not really so much some of the activity going on with the consumer, but also some of the congestion that's really kind of taken hold. When you're looking at where congestion really kind of plays into this or factors in, what does this shutdown do to maybe working through some of that congestion, or does this kind of exacerbate that congestion with another wave potentially coming up as we see some of this really starting to pile up with orders?
Yeah, it's a really interesting question. The congestion we've seen with container ships has mostly been on the US receiving side. So Port of LA Long Beach has 50 plus container ships waiting. Several of the other East Coast ports have also started to have delays and bottlenecks. China, there have been some delays, but less. And look, the ports have remained open through this latest slowdown. Now, if the ports here were to close down, and they may, if there are COVID outbreaks within the labor force in the ports itself, I would expect China to close that particular terminal. If that was the case, then we would see a decline in China's exports. Ironically, that may actually help some of the congestion in North American ports. Like a couple of weeks of fewer ships arriving, for example, would give a good opportunity for some of the US ports to work through those backlogs.
And so, Steve, with that opportunity, we're always watching kind of this bullwhip effect that can take place with that, right? Is slowdown is good in short term, but can then lead to more problems down the road. Can you talk a little bit about what that bullwhip might look like if now these West Coast ports are saying, okay, we have all of this time, we're all caught up, but then there's this sudden lurking import flood, I guess I'm going to call it, that's backed up and then it hits them once again?
Yeah, that's certainly a worry. And I think it actually relates to what you just talked about before I came on. It's like, do we see the continued level of ordering from China and Asia into North America? Inventories are at an all-time high. And there is some evidence that we might start to see consumer spending shift back from goods, which was the big spike during the lockdowns in North America, back towards services. So if I was the optimist on this, I might say that, look, we start to see the beginning of the end here. We start to see consumer spending shift back to services. We start to see inventories high, and therefore we might see the demand for imports moderate.
And Steve, when we're tying this all together, can you really kind of factor also, excuse me, what rates are going to start to kind of play into this as we start to see some of the rates start to come down? Do you see this really being a lasting trend here, or maybe there's going to be some upward pressure coming around in the works here?
Yeah, so rates will definitely moderate over time. I don't think anyone would expect them to come all the way back down to 2019 levels. Capacity will remain constrained for at least through this year. There's a large number of container ships on order arriving in 2023 and 2024. Some of that will be for replacement, but some of that will be additional capacity, and that should help the rates moderate as well in the medium-term horizon.
So, Steve, we talk a lot about how carriers are managing disruption, about how 3PLs and freight forwarders are now having to get pretty creative in their mitigation strategies. But let's talk a little bit about the shipper side of things. How are shippers now starting to handle this, both disruption that they're actively seeing and starting to prepare for what could be continued disruption down the road? Are they changing how they're looking at their supply chains as a whole? And then is that having a downward impact as well?
Yeah, well, in the short term, unfortunately, shippers have limited choice. You either want to move the box or you don't, and if you want to move it, you need to pay the rates the lines are asking. This is, at the moment, a seller's market. We are seeing some creativity using ports they may not have used before, whether it's northwestern ports or the Canadian ports, or increasing volumes to the East Coast. However, if everybody's creative, all of these ports become congested, and that's what we've been seeing recently. In the medium term, there's no question that it leads shippers to look again at supply chains. The idea that container shipping can provide a just-in-time supply chain, I think, has disappeared. And with the additional costs, both of the freight and then also the inventory, that is going to lead to shippers looking at alternative sourcing options or also potentially nearshoring options.
I think that's a great point, especially when looking at that nearshoring options. When we're looking at the supply chain, of course, we've hit a lot of topics this chat just now, but from congestion, rates, containers, moderating trends, things like that. Are there any underlying trends right now that you might be seeing that you think maybe isn't getting enough attention, or that could be very concerning as it might continue to mount as we move throughout 2022?
Yeah, I think we do see, if you were to look at the container shipping industry itself, I meet container shipping executives, and the first thing they do is smile. They're making more money than they've ever made before. But the second thing they do is cry because they are not happy with the quality of service that they are providing to their shipper customers. An on-time performance rate of 20% is not acceptable to anyone who's in a logistics provision business. So I think the container lines also want to see supply chains smooth and come back to normal. And I think the underlying trend which we're seeing, which is interesting, is increasingly sort of multi-year contracts. The container lines are trying to remove the boom and bust cycles which we've seen, both for their industry and also for the rates the shippers pay, towards more stable, longer-term rates, which I think could be a savior for both the container lines and also the shippers alike.
Steve, I think that's interesting because a lot of times it feels almost like those executives are kind of like the big bad wolf, right? They're sitting there raking in all this money and saying, I'm making the money, so it doesn't matter how my customer is being affected. But it's really refreshing to hear that just because they're making a ton of money doesn't mean that they're happy with their performance levels. Do you think that this could lead to kind of a grassroots change almost that starts at the executive level with these shipping companies? And could that kind of change the entire industry as a whole if it comes from the top down?
I think, so first of all, let's put it in perspective. Yes, the container lines are making more money now than they've ever made, but that comes after a decade where they've not covered their cost of capital and they've destroyed value for their investors. So yes, now is a bonanza, but look, it offsets 10 years of misery for them. What do I think changes? I think we are going to see more long-term planning. We see several container lines investing the profits into logistics provision, for example. Logistics provision is a more stable, longer-term, profitable business. And that is also going to remove some of the boom and bust cycles which we've seen in the industry. I think looking forward, we're going to see a more stable container industry, and that's good for the shippers too.
Awesome, Steve. Thank you so much for joining us this morning, especially across the globe. We'll be sure to check in with you, hopefully, if there are any updates here. And thank you so much for joining us this morning.
Great. Thanks for having me on.
Absolutely. All right. And we're going to toss it over to the wall right now. We've got another carrier update with Thomas Wasson.